Hello, welcome to class. And this is the third module of Advanced Taxation class. And we'll be looking into company income tax in Nigeria. We will look into company income tax in Nigeria. And we will look at the determination of adjusted and accessible profit, the basis period for new, continuing, and ceased businesses, capital allowances and balancing adjustments, treatment of losses and group taxation, and the computation of company income tax liability. This is actually going to be brief because of our time, and the full note is available to read through and join the class as such. And company income tax is one of the principal sources of revenue for the Nigerian government and serves as a key instrument for regulating business operations within the country. And it's actually governed principally by the Company Income Tax Act, CAP C21 LFN 2004, as amended by the Finance Act 2019 and 2020. And it actually imposes tax on the profit of companies, whether derived within Nigeria or brought into the country. And the fundamental objective is to ensure that all profits accruing to derived from or received in Nigeria by companies are appropriately captured within the tax net, thereby leading to the national development and fiscal stability. And the computation of CIT is a systematic process that requires careful consideration of accounting profits adjustments for tax purposes, and determination of accessible profits, and the application of statutory tax rates. Now, what is company income tax? It is actually a tax on profits of companies operating in Nigeria, just like we said, talked about the governing law, and the objective is to ensure profits are going to derived from or received in Nigeria fixed. And the key principle is actually accounting profit is not equal to taxable profit. Accounting profit is not equal to taxable profit. We have difference, and we must adjust accounting figures to be able to comply with tax law. And it is when we've done the adjustments that we'll be able to arrive at the taxable profit as such. And determining the adjusted profits, and the starting point is accounting profit from audited financial statements. And adjustments are required because not all accounting expenses are tax deductible and not all accounting income is taxable. So there is need for adjustment in that regard. And the key adjustment that we have is, first one is you add back non-deductible expenses like fines and penalties, non-business expenses, excessive entertainment, and depreciation, which is replaced by capital allowance. And you deduct the likes of the dividend from Nigerian companies, pioneer status profit. And from adjusted to accessible profit. When we talk about accessible profit, this is actually the final taxable profit after all statutory adjustment has been made. And to calculate this is actually adjusted profit minus capital allowance minus loss relief. Adjusted profit minus capital allowance minus loss relief. And the sources of income according to Section 8 of CETA is 1, trade or business, 2 is rent from properties, 3 is investment income, which is dividend interest, and the last one is other profits and gains, other profits and gains. The basis period, it is very important to note these aspects. And when we talk about the basis period, it links accounts to tax. Um, and we have what you call the year of assessment, and this is government tax year. And mostly it is from January, uh, 1st of January to 31st of December. And the basis period is actually the accounting period whose profits are taxed in the given year of assessment. And the key rule is this: for new businesses, specific rule for first 3 years to prevent double taxation. And for continuing business, we use preceding year basis. And for cessation of business, profits are assessed from start of accounting period to the date of cessation, and tax is due within 6 months. For the capital allowance, it's actually also the depreciation as the tax depreciation. And when we talk about this, there are tax deductions for wear and tears on qualifying capital assets like plants, machineries, and the likes. And then it replaces the accounting depreciation for tax computation. And the main types of this is the initial allowance, the annual investment allowance, and the written down allowance. And when we talk about initial allowance, it's one-off allowance in the year of purchase. We have the annual investment allowance, which is annual deduction on cost. And for the written down allowance, it's actually annual percentage on the reducing balance. In selling an asset, um, this is actually triggered when a qualifying asset is sold. A balancing adjustment is actually triggered when a, um, an asset is actually sold and disposed of or ceased to be used in the business. And to calculate this, you compare sales proceed with tax written down value. And uh, the two outcomes will actually be either balancing allowance or balancing charge. And when we talk about balancing allowance, it is if proceeds is less than written down value, then the result will be an additional deduction from taxable profit. But if it is actually if the proceed is greater than written down value, which is balancing charge, then the result will be an addition to taxable profit, and that is clawback of excess relief. In treatment of tax losses under this, a tax loss occur when allowable deductions is greater than assessable profits. And the key rule is actually in section 37 of the Company Income Tax Act. And it actually shows that losses can be carried forward indefinitely to offset future profits from the same trade, and no general carryback of losses in Nigeria. And illustration of this is maybe in 2022, there is a loss of 2 million naira, and in 2023, there was a profit of 3.5 million naira. The taxable profit for 2023 will actually be 3.5 million minus 2 million, which is 1.5 million. That would be the taxable profit for the year assessment. And we have group taxation, and this is known as loss relief. And this allows related companies to surrender losses to profitable companies within the same group. And the key condition for this is parent company must own at least 75% of subsidiary. And the benefit is that it's efficient tax planning by utilizing losses across the group. And an example of this is a parent company having a profit of 6 million, and the subsidiary company having a loss of 4 million, which is surrendered. And the group taxable profit will actually be 6 million minus 4 million, which is 2 million naira. 2 million naira will be the taxable profits. In computing the final company income tax liability, we have a number of steps, which is first determine the adjusted profit, that is, you also calculate the accessible profit. You calculate the accessible profit, and the third one is to apply the correct tax rate based on the annual turnover. And lastly, the calculation of the final, the CIT is actually accessible profit multiplied by the applicable tax rate. And as shown in the table for company size, we have small, medium, and large scale enterprise. And for small, it's less than or equal to 25 million annual gross turnover, and the tax rate is 0. For medium, which has an annual gross, having an annual gross turnover of 25 million to between 25 million and 100 million, having tax rate of 20%, and for large scale, for having an annual gross turnover of 100 million and above, 100 million and above, it's actually having a 30% tax rate. We have a scenario here that we need to quickly look at, and where there is a accounting profit of 40 million naira, and there is need for you to, there are fines, non-deductible entertainment, and there are tax-exempt dividend. For us to be able to adjust this, then you have to add back the fines and non-deductible entertainment to it, and also you deduct the tax-exempt dividend from it to get the adjusted profit of 38.4 million, and you also less the capital allowance of 3 million and loss brought forward of 5 million, which takes the accessible profit to 30,400,000, 30.4 million. And in order to calculate the company income tax, it's actually 30% of the company income tax, which is 9.12 million, 9.12 million. And that's a practical example. And in conclusion, company income tax computation is a reconciliation process from accounting profit to taxable profit, and basis period are crucial for accurate timing of tax assessments. And the capital allowances replace depreciation and significantly impact tax liability. Also, losses are a valuable asset. They can be carried forward or used for group relief. And lastly, compliance with the Act of Company Income Tax and Finance Act is non-negotiable, and mastery of this concept is essential for effective corporate tax practice. Thank you.